What is a market cycle? Financial market prices go up and down over short and long periods of time. The round trip between prices rising and prices falling is called a market cycle. And while it is a matter of opinion about where market prices are going in the future, we have a great deal of data about how financial markets have performed in the past. When prices are rising over time, it is called a bull market, and when prices fall over time, it's called a bear market. How much of a rise and fall in prices is needed to qualify for a bull or bear market is a matter of opinion, but many use a 20% change in price from any market top or bottom as the definition of a bull or bear market. Let's take U.S. stocks as an example. We can use the S&P 500 index of large-cap stocks as a proxy for the stock market. If we measure all of the S&P 500 price performance since 1926, there have been 9 bull markets and 8 bear markets. The average bull market lasted 9 years with an average cumulative return of 472%. The average bear market only lasted for 1.4 years with an average cumulative decline of 41%. It kind of makes you wonder what all the fuss is about. When defined as a 20% change in price from the prior low or high price, the stock market has been in the bullish part of the cycle 80 out of the past 91 years, or 88% of the time. The problem is that the data can be misleading. It is true that the average cumulative decline during bear markets was only 41%, but a 41% decline means that your $500,000 portfolio is now only worth $295,000, and the last 2 bear markets have been whoppers, where the market declined 45% in 2000–2001 and 51% in 2007–2009. When your latest investment statement shows your portfolio lost half its value, it makes it hard to stay objective about investing. Within the bull or bear cycle, there can be smaller price changes called counter-cyclical price moves. That means that even though the average bull market lasted for 9 years, there were plenty of times within that period when prices were falling. Of course, investors don't know if the shorter-term price declines are the harbinger of the next bear market, so smaller price changes over a short period of time can create high anxiety and fear for investors who aren't focused on long-term investing. The data clearly shows that bull markets last much longer than bear markets, and the impact on cumulative price changes is much greater in bull markets than in bear markets. That's good news. The bad news is that bear markets can be so frightening for investors that they sell their stocks at the bottom of the market cycle right before the next bull market is about to begin. The key is to invest your money over a complete market cycle, meaning you are patient enough to hold on to your stock investments during bull markets and bear markets.